Hello everyone, let's take a look at today's market close. US stocks all finished slightly lower today. The Nasdaq dropped 0.28%, the S&P 500 fell 0.17%, and the Dow slipped 0.2%. The declines were very uniform, which tells us this is a systematic moderate pullback rather than a sell-off driven by any single company. Here's an interesting signal though. Even though stocks were down, the VIX volatility index actually fell to 14.25, which means there's no real panic in the market. The real pressure is coming from the bond market. The 10-year Treasury yield climbed to 4.7%, and that's putting valuation pressure on equities. Meanwhile, the dollar index weakened slightly, and the yuan held steady. Gold and oil were the strongest sectors today. Spot gold rose 1.38% to top $4,400 an ounce, and WTI crude gained 1.09%. So what's really happening in this market? Our read is that money isn't leaving the market, it's rotating. Funds are moving out of high-flying tech stocks and volatile speculative names, and some of that capital is flowing into inflation hedges like gold and oil. Bitcoin fell about 1% today, but crypto-related stocks did much worse. MicroStrategy dropped 4.13%, and ARKK lost 1.92%. In a rising rate environment, assets that pay no interest become relatively less attractive. Let's walk through the global trading day. The Asian session was quiet with no major headlines. The yuan was stable, and we saw no meaningful capital outflow pressure. For Europe, we don't have specific index data, but based on the synchronized strength in oil and gold, European money was leaning defensive. In the US session, indices opened lower but trimmed losses by the close, which tells us there was buying interest in the dip. Even within large-cap tech, we saw divergence. Nvidia only fell 0.12%, and Tesla actually rose 0.22%. The real selling pressure was concentrated in thematic and high-leverage names. Comparing to our morning report, the big picture call was correct. The market did not see a systemic decline. But we need to own two mistakes. First, we said commodities would weaken. That was wrong. Commodities were the strongest sector today. Second, we underestimated the impact of the 10-year yield move. 4.7% is a critical level that clearly pressured growth stock valuations. There's an important divergence here that deserves your attention. Normally when yields rise, the dollar strengthens. But today the dollar weakened. This suggests the yield move is not driven by strong economic data or rate hike expectations. It's more likely supply-driven or inflation expectation-driven. The implication is that money is looking for havens outside dollar assets, and that explains why gold is so strong. Looking ahead to tomorrow, we need to watch three key variables. First, can the 10-year yield hold above 4.7%? If it breaks above 4.8, we would cancel all long bias and move to the sidelines. Second, can oil and gold extend their gains? Third, can crypto-related names like MicroStrategy and ARKK find a floor? On strategy, we recommend keeping positions controlled, leaning toward the commodity chain and defensive assets, and reducing tech growth exposure to neutral. If Bitcoin breaks below $62,000, or if the yuan depreciates quickly past 6.76, that would signal a real deterioration in risk appetite, and you should cut exposure immediately. Our probability assessment for tomorrow is 35% up, 40% sideways, 25% down. That's all for today. We'll see you tomorrow morning.